All right, in this video I'm going to cover a number of different retirement topics, and I've got some of them listed up there. Uh, and there are a lot of different things with retirement, so it's kind of complex. And so just let's take it piece by piece. I'll do my best to explain the basics of each section, um, and then go into more detail in a different way. Okay? So the first thing we want to understand is the difference between a traditional retirement account and a Roth retirement account. And so the gist is this. Traditional is what we normally think of. When we put money into it, we get a tax deduction. And when we take the money out, we get taxed on the money that we take out. So in a sense, it's called tax-free in, taxed out. Okay, so we put money in and we get a tax deduction. It reduces our taxable income, therefore we pay less taxes that year. But when we take the money out in a few years or many years later, depending on your situation, it will be included in income, whatever comes out of the account then. It does have the benefit of while the money is in there, you can use it to invest, and that money will grow, and any earnings on that money will also be tax free for the year that they're earned. It's only whatever comes out of your account gets taxed. Roth is the opposite. When it goes in, you still get taxed. You get no deduction, which means it's essentially taxed. And when it comes out, it's not taxed. So it's the reverse. Okay? Which people like paying their taxes now and getting it out of the way. That's one of the main benefits people like Roth so much because their taxes is done no matter what happens to the taxes in the future. I've paid the taxes on my Roth money. So if taxes go up or go down, don't have to care. It's done. It's paid for. Okay? Okay, other than that, I want to talk about the difference between 401ks and IRAs. So a 401k is essentially your company plan. Your company runs the plan and has it available for you to invest in. An IRA is an individual retirement account. It's all on your own. You're by yourself essentially. It's just yourself. Okay? And that's the difference. 401ks to contribute to those, they have to take money out of your paycheck. An IRA, you can just contribute. You don't have to have it, you don't have to have them take money out of your paycheck to contribute to an IRA. You can just go and open up an IRA and wire money straight from your bank account. Okay. Now, the thing is, there are limits to how much money you can put into a retirement account. Traditional or Roth, the rules are the same as far as how much money you can put in. For 401k, every year you can put in 22,500. That's how much you can put in for 2023 going forward until they change it again. Okay, so in this year you put in 22,500 through my 401k, or if it's a government employee, it might be a 403A or B or whatever. Um, Whereas with an IRA, we can only put in 6,500 in a year, which means we can't get as much retirement money going if we just do an IRA. The best way to put in a lot of money for retirement is to go 401k route. So that's why a lot of people like to have a company that has 401ks. Not only that, a lot of companies will give an added benefit of also contributing money to the 401k for you. So if 401k has what's called 401k match, they can also put money in addition to your 22,000. They could put in, generally it's a percentage of your salary, so 2, 3, 4, 5, 6%. So it just depends on what your salary is and what the company's match percentage is, but it can add up quick, especially if you're making good money. Okay. When you become over 50, you can do catch up and just like, oh gosh, I'm 50 years old. I don't have enough in retirement yet. I need to start getting more money in quickly. So they allow a catch up, which means you can contribute more money in than you normally would be allowed to. So if you're over 50, you can contribute an additional 7,500 towards your 401ks, which means you can put up to 30,000 in a year as long as you're over 50. If you're over 50, an IRA only lets you put in an additional 1,000. So the most you can put in an IRA once you're over 50 would be 7,500. So still not nearly as much as the 401k will allow you. So obviously 401k, she puts in lots of money. Okay. All right. Moving down to RMDs. RMDs is a topic that comes from the traditional retirement plans, and it's required minimum distributions. So because you get taxed when you take that money out, they want to get their tax money. And in order to do that, they got to force you to take your money out of your retirement account. So here's what we're going to do. We're going to have RMD. It's a tax law that says once you hit 73 years old, you have to start taking a minimum amount out of that account every year. And they have a formula for it. The formula is not important. The important part is to remember that they need to take those RMDs. Okay. Usually, whoever is running your retirement account for you, as like whatever broker you have it with, whether it's Fidelity or Ameritrade or whatever, um, they will calculate your RMD for you, so you don't have to do that. But the thing to know as a tax preparer is to be aware of 73 years old. Okay, did you do your RMD? Where's your RMD? Okay. When you start to get to the point where you have RMDs, you have to pay those. You have to make sure that you're taking those out. When you turn 73, you have to start taking them out by April 1 of the next year. So if you turned 73 in the year of 2023, April 1 of 2024 would be your first RMD, and you have to take an RMD every year until you're dead or your account's empty. So this is when you would start. April 1st is when it's due by. You can take it out before then, but that's when you have to get it done. Okay, that's your deadline. Now, one other thing about Roths and why people like Roths is because Roths for RMDs, they don't do them. They just don't have to. That's part of the rule because we've already got our tax money. We don't care if you keep your money in there. That's up to you. You don't want your money, that's fine because whenever you take it out, it's not taxed anyways, so the government doesn't care when you take it out. That's the gist of why there's no RMDs on the Roth. Okay. All right. Early distribution. Retirement money is for retirement. And so because it's for retirement, you can't take it out until you're retired. And just to make an easy, arbitrary rule of who's retired and who's not, the answer is 59 and a half. If you are over 59 and a half, you can take your retirement money out and that's fine. Okay? If you are younger than 59 and a half, you get what's called an early distribution penalty. All right? Any money you take out of your retirement account, if you're younger than 59 and a half, you're going to take a 10% penalty. Okay? Which is not great. So if you take out $10,000, $1,000 is going to the government just because you took it out too early. In fact, I had a situation one time where I had a client, their tax return was handed to me by another preparer to look over and review it, and kind of just putting little finish touches on it. And so I started looking through it, and this guy had taken out about $70,000 of retirement money, and his age was 59, and the code on it was an early distribution code by the retirement account place because they saw he was 59. And so I looked at his age, realized, and that he was hitting 59 and a half in that tax year. So I ended up calling the client and asking them how old they were when they took that distribution. Were they over their 59 and a half, day? And I had their birthday, so I asked them, was it before or after this date, which would be 59 and a half. And he clarified that yes, it was after his 59 and a half mark, so that the penalty should not apply. And so that ended up that client paid $7,000 less of tax because we made sure that he had made sure that he had gotten his his money after he hit that 59.5 mark. And so it really adds up whenever you're talking about your distributions later on in life, because it's a lot of money going to be taken out to live. There are some exceptions to this, so I'm going to go ahead and open up the 4012. If you go down into other taxes, on page H7, there are a list of exceptions to the early distribution penalty. Just depends on which one you might qualify for, or you might not qualify for any of them. There is one in here. Let me find where it is. This one, number 9. This one I actually used myself whenever I purchased my home, because as a tax preparer, I knew these exceptions. And there's a lot of different ones, but this one I like them a lot because it's something that younger people can take advantage of very easily. Which is, if you take money out of your retirement accounts for the purchase of your first home, buying your first home, um, you can take out $10,000 and not pay the tax penalty. Now, your regular tax amount, if it's a traditional account, you still have to pay your regular tax on it because it is going to be taxable income, but you don't have that 10% $1,000 penalty there. So that is nice, and I actually did use that. I contributed into my company's simple IRA plan and was saved up about just under $10,000. I think I had about 9,800 in that account. And so when I went to go buy my house, I took all that money out and used that for my down payment. Made it very easy to put that money aside, keep it aside out of the way, and then also be able to take it out and not have that penalty on it. So very good technique for getting that first home. I know that gets talked a lot about in this millennial age. So just something to keep aware of. There are exceptions. Some of them are like medical um, situations. So like we have total and permanent disability, and so there's a lot of different ones. So if they happen to have one that is that is going to be early distribution, you might go through this list with the client and just kind of see if any of these apply. Okay, so that's H7, tab H, page 7. Now, when you get a form, it's going to be called called a 1099-R, and when you are looking at it, there are going to be different distribution codes, and so this is going to be kind of a little guide, and you can find this in tab D, page 50. It gives you the explanation of each code, and so a lot of them will be just a code 7, which is just normal. You don't really have to memorize this either. It's just important to know where to find this. It's in T7 under the retirement stuff. And usually when we're talking about early distribution, it's got that code 1. And that's a code meaning early distribution, and the retirement plan, the people who manage the plan for them, don't know what exception, if there is one. Whereas a 2 means you kind of gave them uh, an explanation of why this was an exception to that distribution penalty. So just a few things to point out there. All right, let's get back to the screen. All right, last thing I want to talk about is Social Security. Now, Social Security is mandated retirement. They take it out of your paychecks throughout your working year, and they basically put it aside and will pay you retirement benefits, Social Security benefits, when you get to the retirement age, somewhere around 68 to 70 years old. By the time most of the the high schoolers I teach, and even me, get to that age, it's probably going to be 72 that we actually get to take our Social Security retirement benefits. Now, Social Security benefits, because we don't get a tax deduction now, we do get um, a little bit of a break with our taxes on them later. So depending on your income, your Social Security could be 0% taxable, or it could be 50%, or it could be 85%. Okay? And so if you make less than 25,000 as a single or qualifying surviving spouse or head of household, um, then you get, if your income is less than 25, including half of your Social Security money, then you have 0% tax on that Social Security money. If you are married filing jointly, that number is 32,000. Single, married filing jointly. That's also like qualifying spouse, head of household, that type of stuff. But the big deal is married filing separately, they get nothing. So once again, this is another reason married filing separately loses out on some sort of benefits. All their money from Social Security is taxable at some percentage. Uh, Now, if you're above this line, you're at least 50%. And then from this number until you get to your next level, which is for single, it's 34, and for married, it's 44. Okay. Once you hit that mark, then everything after that, it doesn't matter. You're no longer changing it. But from below 25 and 32, it's 0%. Once you get to there, it's 50%. And the more you go over 25, the more higher of a percentage you get taxed on your Social Security until you get to here. And then once you make more than this, all your Social Security is 85. That's the most your Social Security will be taxed. So if you have $10,000 of Social Security, the most taxable income you would have is $8,500 of taxable income. Okay, that one's a little more confusing, but just kind of understand that it's not fully taxable, and that those are the main rates you'll see is 0, 50, or 85. All right, I think I covered pretty much all the topics. Please make sure to use the 4012 as in addition to what I have explained to you. Let me get the topic number, question numbers for you. Let's see here. All right. For the basic, RMDs will be question number 10. Social Security will be question number 18. RMDs 10, and then early distributions will be question 27. On the other side, we have early distribution penalty for advance is 28. And then Social Security is 16. Okay. All right. And there is no question about RMDs on the advance return this year. So be it. All right. So using the information from this lecture and the information that I pointed out in your 4012, go and answer those questions um, on your exams. Good luck. In fact, I just noticed this whole time this was backwards. It should be when you're over 50, not less than 50. Whoops.